Hi there, Evan here at the Machronicle, where the future starts today. For Friday the 13th, September 2019, bond yields globally are about 30 to 40 basis points off the bottom since the Tuesday after Labor Day. Purpose of today's video, I want to go into some of the events that are driving this and what I think is going to happen going forward. First, let's flash back to around 3 or 4 weeks ago when the US Treasury floated the idea of a 50 or 100-year bond. In fact, they were echoing this last night into this morning also. US has a high sovereign debt to GDP, they're now running trillion-dollar plus deficits, and floated the idea of an ultra-long-term bond to keep the borrowing costs suppressed. That's really what it's for. And then flash forward to right around 2 weeks ago, Germany had stated they wanted to go ahead and do fiscal stimulus. Well, there's one big problem in Germany. Germany, like many other parts of Europe, already has negative yields. So in other words, they would go ahead, borrow more money, and with negative yields, you would pay them back a dividend for borrowing more money. Some people saw this and basically said, okay, you want to go ahead and borrow more money, we're not paying you a dividend for the privilege of doing this anymore. They went ahead and sold bonds. Yields started coming off the bottom. And then obviously what happened in Europe started translating globally, and globally bar Japan and a few Asian countries, we're about 30 to 40 basis points off the bottom now. Now here's my take. Remember this. You see, positioning had gotten really extreme. But to put up a chart right now, the RSI on US 10-year bond yields was at a 20-year low. And obviously, lower yields mean higher bond prices, which then consequently means the RSI on 10-year bonds was then at a 20-year high. In fact, go around, look what was happening on TV really the past month or so. There's people coming on TV calling for a 50 basis point rate cut at the next meeting, and then 50 basis points in December, which total for 2019 would have been 125 basis points. As per my predictions, that was way too many. So positioning had gotten way too extreme. People expected 125 basis points for this year. Was far too many for my predictions, for many others in the market. Yes, speculative positioning was high, but it needed a trigger to create the washout that's happened here the last couple of weeks. Those two events that I mentioned earlier were the trigger, hence the sell-off started to happen. Now, what do I think over the medium term? Does this change my prediction about bond yields going lower because of a slowing economy and easing by central banks? I don't think so. There's two reasons for it. One, growth around the world is still in a massive slowdown. That's going to keep a lid on long-end bond yields, which are very sensitive to growth. Now, my second reason for still being bullish, central banks. Now, I know what you're going to say. Core inflation globally has been ramping higher the last couple of months. Remember, central banks have dual mandates: inflation and the markets. And when the economy starts slowing down, as the ECB stated yesterday by restarting QE, they're going to look after the markets before they look after inflation. In fact, as I said 18 months ago, as the currency market said 18 months ago, at the first sign of trouble, they would go right back into QE. What did they announce yesterday? $20 billion a month of QE. And right now, the German 10-year yield, for example, is between negative 40 to negative 45 basis points as of filming this. And when any bond within a country, within the parameters of the ECB, when that bond hits zero, the ECB is going to go ahead and buy it. They've pretty much admitted that the last time they did QE, they admitted it yesterday by starting off with $20 billion per month of QE, and it's only going to grow from here. So how do you go ahead and play this? We know that yes, as the economy keeps slowing, central banks will keep easing. We know that as the economy is slowing, that's going to put a lid with how high long-term bond yields can go, even in the short term. And also, with high sovereign debt loads globally, personally myself, I really don't want to own an ultra long-term bond either, say 25 years or longer. As rightfully so, there is a little bit of worry about how we're going to deal with this long term. So perfect time frame for me would be 10 to 20-year bonds. There's an ETF for that in New York called the TLH. When the Fed cuts interest rates at their next meeting next week, on that, you go ahead and buy bonds again. And why am I picking that? Look at the rate differentials between the US and the rest of the globe. And also, it's priced, of course, in US dollars. And as the Canadian dollar, or most other currencies for that matter, weaken further against the US dollar, it gives you additional appreciation on that also. So hope that clarified it. Hope it helped. That's all I'm going to say. Smash that like button, leave a comment, subscribe, follow both my Twitter accounts, and as always, my name is Evan. This is the McChronicle, where the future starts today.